Hello guys, welcome to the next video where we are solving the final sum, question 14 from the ISC 2023 question paper for accountancy. If you have missed out the previous videos, do check out the entire playlist from the description box below. And if you don't want to miss out any future videos, then you have to click on the subscribe button and hit the bell icon. The final sum, this is the sum on ratio analysis. So let's get started with the sums, the sub parts that we have. The first one, we have to calculate the debt to total asset ratio. And let's look at the information that we have. We have property, plant and equipment, we have shares, we have long-term loans and advances, current assets, current liabilities and total debt. All right, so debt to total assets, the formula is debt by total assets. Okay, we have to calculate the total assets and debt, which is the long-term debt, separately. So now this is an interesting sum where you are given long-term loans and advances as one of the items, and a lot of people confuse, a lot of students confuse this to be as debt. However, this is long-term loans and advances. This is an item of asset side, right? And this has to be considered as part of assets. This is to check your presence of mind. This is given on purpose here so that you are able to pick up or not. That is to be checked. All right. So in terms of total assets, then what all items have we got? We have got property, plant, and equipment and intangible assets, which is 20 lakhs, right? Then we have got the long-term loans and advances, which are 1 lakh, and then we have got our current assets, which are 10 lakhs, right? So how much do we get? 20 lakhs plus 10 lakhs plus 1 lakh, which is 31 lakhs. All right, that is our total assets. Coming to long-term debt, now we have the total debts given to us. Total debt is 12 lakhs and we have the current liabilities given to us 4 lakhs. So the long-term debt will be total debt minus current liabilities, right? A straightforward sum which we have done number of times previously as well. So that's just a general understanding that we have, right? So that comes to 8 lakhs. So we have got these figures. Now we have to just plot them in our formula, total assets and debt. So debt is in the numerator, 8 lakh goes up here and 31 lakhs comes in the denominator, right? Let's solve it. We get it as 0.26. That's our debt to total assets ratio, right? So that's 0.26 is to 1. If you want to measure that, write that in terms of ratio format. Then that becomes our ratio, which is 0.26 is to 1. All right, let's move on to Roman 2 that we have calculation of trade payables turnover ratio and another interesting sum given here. Now see here, we have the opening and the closing trade payables given to us, but we have the payment made to trade payable. This is interesting. We have returns to creditors, returns to credit suppliers as well, 30,000, right? The formula we know, we have the trade payables like net credit purchases by average trade payables, where we have the average trade payables given to us. However, like we can calculate from the opening and the closing trade payables. However, the credit purchases or net credit purchases are not given to us. For that, we are required to prepare the entire trade payables account like any other ledger account, right? Let's do that. So we have the opening balance given to us, which comes on the credit side, as these are liabilities by balance BD. So we write here 70,000. Then we also write down the closing balance, balance CD, that's 80,000, right? Payment made to trade payables, which is straight away to cash account. Payment made 3,20,000, and the returns that we have to the suppliers. So returns to creditors to returns, we have 30,000. The balancing figure is nothing but the purchases, which are the credit purchases. Okay, so that's the balancing figure that we have. How much are we getting? Let's do the total here. So that is straight away 4 lakh 30 minus 70, 3 lakh 60,000 is the net, is the credit purchases, not the net credit purchases. So let's come back to our formula. Average trade payables, we have the amounts given to us, which is 70,000 plus 80,000 divided by 2, right? That comes to how much? 70 plus 50, 70 plus 80 by 2. That gives us 75,000. Okay. Net credit purchases, total credit purchases minus returns. Just now we calculated our credit purchases total is 3 lakh 60 and our returns are 30,000, right? Just now we calculated, so this becomes 3 lakh 60,000 minus 30,000, which comes to 3 lakh 30,000. Okay, let's put these values in our formula. Net credit purchases 3 lakh 30,000 and average trade payables, which are 75,000. Let's solve this. How much do we get? That's coming to two decimal places. We have to keep our answers. So that's 4.40. All right. So number two is done as well. Let's move on to the third one. We have to calculate the quick ratio. The formula is quick assets by current liabilities. We have been given the current assets, the total current assets are given, the working capital is given, the prepaid expenses are given. All right. So using the formula of working capital, which is current assets minus current liabilities, we can calculate the current liabilities, which is the missing amount. So let's do that. 60,000 equals current assets, which is 90,000 minus current liabilities. So in that case, current liabilities will be equals to 90,000 minus 60,000, right? They interchange their places. Minus 60,000. So the current liabilities come to 30,000. That's our current liabilities. One thing is calculated. Now let's calculate the quick assets. Quick assets are current assets minus inventories minus prepaid expenses. We don't have inventories here. However, we do have prepaid expenses. So we'll subtract that from current assets. So 90,000 minus 30,000, that's 60,000. So our quick assets are 60,000. Let's put that value here in the formula, 60,000 by 30,000. So how much do we get? Which is a straightforward calculation, 2 is to 1. So our ratio is 2 is to 1. Okay, that's our quick ratio. This is done as well. Let's move on to the last part, section 4, where we are required to calculate the profit for the year. We are given the inventory turnover ratio, which was 8 times. We have the average inventory given to us. So let's calculate the missing figure, which is the cost of revenue from operations from this formula. 8 is the inventory turnover ratio, cost of revenue from operations not given, and average inventory is given as 40,000. That means the cost of revenue from operations will be equals to 40,000 into 8, a straightforward solution for the equation, and that gives us 3,20,000. That's our cost of revenue from operations. You can also call it Cost of goods sold. The profit is mentioned as 25% on cost. That makes things easier for us. The cost we already have as 3,20,000. So the profit is 25% on that. So 3,20,000 into 25%. That's the profit. And we are required to calculate the profit only. So that becomes 25% into 3,20,000. So 80,000 is the profit which has been made. That's the solution for this sum. Hope this was helpful and make things easy for you to understand. Hit the like button if it did, do share with your friends. Stay tuned for more videos on this channel. Thanks for watching, guys.